Zoom's open up. We get Clubhouse going. Hey, good morning, everybody. It is Mike, one of your co-hosts for the Multifamily Unplugged, the #1 Saturday morning radio show. Hey, you know, I really think that this is probably the only Saturday morning on radio show, especially Unplugged after Friday night, right? Hey, listen, if you are joining us live on Clubhouse, we are live on Facebook and we are live on Zoom also. This is the Saturday morning radio show, Multifamily Unplugged. I'm joined by my co-host this morning, Carl Moose, who we proudly call Moose. Hey, Carl, what's up?
How are you, Mike? Good to see you again.
I'm good. Yeah, did you have a good night last night?
Well, yeah, I did. I had a cigar with a couple buddies of mine, kind of hung out, and I was in bed early. How about you?
It's always about you on Friday night, isn't it, Carl? Being the only night you get to go out. Anyhow, let's get this thing kicked off. Hey, Saturday morning, this is where we dive into raw, unscripted conversation about multifamily real estate, property management, and some current events. And boy, there were some events this week that we'll probably talk about. We'll have to find them. Carl, why don't you look on the news stream, see what you can find. Today's show is brought to you by My Core Intentions and your Focus Guy. It's where we bring you the most defined real estate strategic training programs on mindset and multifamily that you can find. Hey, like I said, I'm Mike Morawski. I'm joined with my co-host, Carl Moose. We are live on Facebook, Clubhouse, and Zoom here this morning. Go wake somebody up. Let's get this thing kicked off and let's get rolling. Grab your coffee, sit back, enjoy the ride, because I know this morning we got a ride for you. Hey, before we get started, let me ask you a favor. Please go to social media. Follow me on social media, on Facebook, LinkedIn, Instagram, and Twitter. Follow My Core Intentions. We're on Clubhouse also, so make sure you're following us on Clubhouse so you can get to all the information that we're bringing you. And if you're watching this out on YouTube, please subscribe to our YouTube channel. Write a review. We would love that. Just kind of help our ratings if you would. Thank you. But I'm glad that you're here this morning. And let me just jump in real quick. We are joined this morning by Larry Pendleton. Larry is going to bring us some crazy information this morning. And I'm going to let Larry introduce himself real quick. Hey, Larry, good morning. Glad you're here.
Good morning. Good morning. Thank you, Mike. Thank you, Moose. Grateful to be up here. Yes, Larry Pendleton, CPA out of Hampton Roads, Virginia, Norfolk, Virginia Beach area, for those not familiar, on the southeast side. Been CPA, accounting, tax strategy.
Hey. I just said say hi. Let's not get too carried away yet this morning. Wow, right away, the guy wants to run away with the show.
Hey.
Okay,
Go for it, Larry. Go for it.
Larry, I'm just teasing you. Go ahead. Tell us your background, please.
Oh, no, that's fine. So, I've been tax strategist, CPA, accounting for over a little over a decade. Been investing in real estate myself for a little over 5-6 years now. Started focusing more into multifamily around the end of 2018, and just been adding value to other people in regards to just different tax strategies when they looking to acquire multifamily, as well as if they decide to exit and sell as well. So I say that's pretty much a 50,000 mile high assessment of where I'm at right now.
Yeah, and Larry, I had asked you to be on with us this morning because you and I have had a couple of conversations prior to this, and you're really big out on social media. I see you around a lot, and we've had some conversations. So we're going to roll our sleeves up and dig into some things. And this is where I always tell people, hey, just sit back and enjoy the ride, because we never know which rabbit hole we're going to find. So, Carl, why don't you tell us what's going on here this morning?
You on mute, Carl.
Carl, I think you're muted, Carl.
I don't know why. Okay, yeah, I'm on mute. I don't know why that happens. Yeah, just a couple of things in the news we could talk about in a minute, Mike. Student housing is a subject that people are talking about these days, and also senior housing. So, with the university enrollment down because of everything that's happened in 2020, it's that's on the radar of people right now. But so, Larry, just real quickly, I do want to get to know you a little bit more. So, tell us a little bit about your current portfolio, or what you mentioned you're looking for multifamily, but did you start with condos or rehabs, or how did you get started? Because a lot of the people that are listening are they're looking at getting started. So I'm just curious about how you started.
Yeah, probably the similar route as many investors, kind of just thinking small. Like I said, I was going to do a house, so starting the single family realm, mostly on the rental side. I've done a couple of flips after that, but like I said, I always saw the benefit of just owning the asset long term from a wealth perspective and a tax perspective as well. So I was always interested in just kind of slowly kind of building the portfolio and not really realizing that, okay, I could just learn more about the multifamily and jump into bigger stuff off the break. So I said, kind of just educating myself, still kind of picking up small properties along the way. Recently closed on a 20 unit a couple of weeks ago with Rise Equity Group. That put my personal portfolio all on the GP side, roughly around 53 doors as of today, and looking to grow more as well. But like I said, it's kind of an interesting time where like you kind of see a lot of opportunities with the medium 10 to 80 unit apartments. But if there's opportunity for something bigger, like I said, we're also looking into that as well.
Yeah. Hey, let me just do this really quick, Carl, and then I'll let you go back. Okay. Hey, I just want to reset the room. Good morning. If you're joining us on Clubhouse, this is Multifamily Unplugged, Saturday morning, your raw unscripted radio. And if you're joining us on Facebook or on Zoom, listen, if you have questions for Larry this morning or questions for Moose or myself, please drop them in the chat. Unfortunately, if you're on Clubhouse, you switch over to Facebook and throw something in the chat if you want us. But let me say hi to a couple people here this morning. Mark Brown, what's up, buddy? There's a great picture of you this week out on social media. You clean up well, that's for sure. And Isabel, good to see you this morning. And Jonathan, you too. Hey, Larry, good to see you. And anybody else that's coming on, go wake somebody up. Hey, Isabel, by the way, let you and I connect. We have a couple things we need to chat about. So we can do that later. But okay, Larry, welcome. We're joined by Larry Pendleton this morning, CPA tax guy that has a big footprint in the multifamily space. So Carl, go ahead.
Yeah, no, that's really great to learn more about that. And, Mike and I are a little bit different. I owned at one point, I think about 22 buildings, but the biggest one was about 28 units. So I never got into the, 80, 100, 200, 300 unit buildings like Mike did. And again, I got to a point in my career where I had to make a decision. Was I going to grow or kind of put the brakes on this? And I decided, because of the timing and everything, to put the brakes on it. But I mean, that's a great space, that 8 to 20, 30, 40 unit buildings, there's a lot of opportunities there. And, I think what a lot of people miss, and I saw this when I was a banker, I got into it because as a banker, I saw all these people, doing really well in multifamily. A lot of people don't take that step because they think it's a whole different world, a whole different universe. And, going from a 2 flat or 3 flat up to an 8 flat or 16 or 20. And, I always tell them it's not really that big of a jump. I mean, are there some different nuances and things, of course, but it's great that you're in that space, because I think there's a lot of opportunity there. And I think, the big institutional players like the insurance companies and the REITs and so on and so forth, they're not compressing cap rates down in that segment of the market because they're really not looking for those smaller properties. They're looking for those, 100, 200,000 unit opportunities. So it's really interesting that's your space. Now,
yeah.
Do you manage them yourselves, or do you have third-party management?
We use third-party management. And we're primarily
And
focused.
how do you,
I'm sorry, go ahead.
I was just saying, and how do you find, how do you find, are they all in the same geographic area, or are they spread out, or what's the situation there?
Yeah, so our primary focus at the moment right now has been in the southeastern states. So you kind of network and working with different coaching programs, and when we wish the whole aspect of how the team of Rise kind of came together is just more of just you kind of get into these groups, you start networking with people, and somebody puts it all together, and it's like, okay, this makes sense. And I mean, to your point of like people thinking that it's a huge next step, and it's really more of like, can you basically check your ego at the door and
Mm.
allow yourself to build a team around you so that you're not having to oversee every single aspect of it, which opens up the opportunity to meet more property management companies, get actual reviews from people, not through the property management companies. It's like, okay, have you talked to this firm or talked to this company, and they'll give you the real rundown of if you should work with them or not. So that's kind of how I took the approach with multifamily. Is like if I could just kind of build the right teams around me so I can focus on my strengths, they'll allow us to kind of take on any particular project that comes our way.
That's interesting. I like what you said, Larry, about check your ego at the door, because I think that when you've got more people involved and J. Paul Getty said that if you he'd rather own 5% of 100 things than own 100% of one thing, right? And I think that goes back to ego, because if you think that you're going to have it all or hold on to it all yourself, I think that that's where we can tend to make some mistakes along the way and have some problems come up. But if we're of that mindset of win-win, of sharing, of networking, this is a relationship business, right? This is about being in relationship with people, getting to know each other, helping each other, lifting each other up. And I really think that that's what drives the business, whether, any type of this real estate investing business, right? It doesn't matter which asset class you're in. And that's why I like real estate so much, is because there's so many asset classes. But let me ask you this real quick. What impact is this pandemic and this season that we've been going through for the last year having on your business? Or, better yet, what do you see it looking like on your business down the road?
Yeah, so you're definitely a bit more conservative underwriting when it comes to, okay, what are rents going to be, what are potential vacancies. I mean, a lot of people are still getting relief and they're paying their rents, and with that, so you're having to project, okay, like when you're doing those lease audits and whatnot, and you're meeting with the tenants and like what's their story behind, like are they able to actually pay their rents based off of their job. And so you're looking at the job market that you're in. So you're doing a little more deeper assessing from that standpoint there. I mean, I know a lot of people do the basically a 30% or somewhere in that range of the um, household income, and that determines what their projected rent will be. And it's like, okay, do you even have to be a little more conservative from that standpoint there? So it's really just kind of sticking to your numbers, not because there's so much on the market in regards to just there's so much people trying to sell because cap rates are so pressed at the moment, and there's a lot of money just kind of being thrown out there, and you do have
Hey,
investors who need somewhere to park their money yet. So, but you don't want to jump into a bad deal either.
right. Yeah, let me ask you this. You said that, normally, and I like this number too, 30% of household income, right?
Mm.
So, are you still using that? And then what about vacancy? I mean, I would typically underwrite a deal where I had a 10% vacancy and maybe a 5% loss to lease, somewhere right in that range, maybe 15%, call it all day. But where are you at today? What are you looking at today when you underwrite these?
Still roughly at that 30%. Like, okay, do we bump it up to 35, 40, depending on the area? So it's the underwriting. You do have your high level underwriting just to kind of get things started, because as both of you know, you can spend hours um, just underwriting one deal, and you
Yeah.
kind of lose track and find out that the numbers don't work. So you still have like, okay, here's the baseline, whether you're doing 1% rule. We typically do 1.3, that 30% household income. Yeah, we'll do 10%, factor in 10%. Okay, if it passes those sniff tests, do we do a deeper dive where we're trying to mirror what the actual market is? Like I said, some markets where it's actually 8, 7% vacancy. But we typically start off with 10. If the numbers still work out from there, okay, then do we scale it down to the 8% and see how well we can sharpen our pencils and come up with a stronger offer. Another aspect that's really playing a huge factor is the cost of material. If you're doing new development, or if you're doing repositions or any type of rehab, that even for the concept of lumber, then those numbers shooting up. Okay, if any of the renovations that you're doing is going to require lumber, and how that's going to affect, because sometimes we're ranging between 5, 10,000 a unit for repairs. If we're having to turn up, once we factor in how many units we do need to turn over.
What's interesting is what you're talking about, cost of material, right? I mean, lumber cost is crazy. I talked to a buddy of mine yesterday, and he called me from Home Depot. He goes, "Hey, when did 2x4s go to $7?" I said, I said, "That's crazy, isn't it?" But here's how I know this, because I'm getting ready to go vertical on a couple of new single family homes in the south, in a couple of south neighborhoods in Chicago, and we're looking at the builder that we're working with said, "Look, pre-COVID, I could have built this for 110 a square foot. Today we're looking at 133 a square foot, and we're not upper end, right? This is just a notch or two above a Menards finish. So it's really interesting where this pricing is gone and how that's affecting everything, right? Um, and then the other thing is, when you're syndicating some deals, right? You're
Yes.
you're okay. So what are your investors looking for? What's a typical return on that investment that your investors are looking for right now?
Yeah, I think most investors are looking from at least that 15+% IRR, as well as, I mean, I think they're trying to get something in the double digit returns. So even cash on cash, they're looking for at least 10%, and then I really believe it's probably more 16% IRR from that standpoint. But then at the end of the day, it's like how are their investments are being protected? Because there's a small group that would take a smaller return if it's a more secure property that doesn't require as much renovation. So, but they just, once again, that if they're getting 7, 8% cash on cash return, they're still better than what they have is sitting in the wherever account market retirement account that they have it sitting in at the moment right now. So, but it's still perceived as safe because, okay, this property is already 90% occupied. There's a strong market, strong jobs around it, so it's kind of less risk, and less return. But like I said, but people are still kind of wary to, like, okay, we're going to do a heavy rehab or a true value add. Okay, they're looking
Right.
at the double digit cash on cash and IRR returns.
So I got a couple questions for you. One, would you please explain the difference? Because I know that we have a bunch of listeners that'll listen in that don't understand fully IRR.
Hmm.
But can you explain the difference just from a 10,000 foot view? Because I know let's not get into a real rabbit hole with it, but
Right.
the difference between ROI and our IRR.
Yeah, so the best way I try to tell people is, like, your cash on cash. If you put the money out and you put 100,000 out and you're going to get 10% return, like you end up getting um, that return on that standpoint at 10,000 from just cash on cash. You receive that, but that doesn't really factor in how efficiently you receive that money. With IRR, it's a very convoluted calculation that factors in the efficiency of the returns and how quickly you're getting your money back from that standpoint. So that's the true for me. That's the best way I typically try to explain to a cash on cash. Like, you're going to get your return, but without factoring time. IRR factors in the time. So if
Right.
it if you get in 5 years, of course that's better than getting in 10 years. It still be
Right.
10% return, but you got it at a more efficient rate with if you invested into a syndication with the syndicate completely turn the property in 5 years, or return all
So
capital, I should say, in 5 years.
just so everybody's clear on this, ROI is return on investment and IRR is internal return on investment. And the IRR takes in the time, it takes in the time factor of money, which, there's a whole calculation to go through, but your typical IRR return is really what you want to look at on a syndicated deal because of the time factor of money. So it's easier explained when you're looking at an offering or the numbers are written out. So it's helpful.
I think you bring up a good point though, you guys. When you're analyzing a piece of property, really you want to be familiar with all the different ways to take a look at it, because some people, every investor has a different agenda, or they have a different mode that they want to operate in. Some people are okay with an investment that's going to mature over 5 years. Some people want their money back in 6 months. So I think it's really important, for people that are listening to, when Larry's talking about this stuff and Mike and I are talking about this stuff, is make notes. I mean, if we mentioned a term or something like IRR and you don't understand what that is, reach out to us and we'll help you understand that. Or go to Google or go to a podcast or somewhere, and get that information, because that's the language of real estate. It really is. It's the language of banking. It's the language of real estate. And the more you can familiarize yourself with that, just the better investor you're going to be. And then, the other thing, Larry, Mike is a huge networker. You mentioned networking. Networking is a big part of my business as well. So, tell us how you network in this environment and what's going on and how you're staying active, because I'm curious to hear about that.
Yeah, it was funny because I just got off speaking at Cornelius Cannon's capital raising secret event this past week, and we had a lunch and learn yesterday, and one of the not the speakers was one of the viewers just asked, because she was new, like how are you, like what's your plan when you're going into these networking events? And my answer was, it took me a while to figure it out, but it's to kind of add value. Like I kind of go to all of these events or any speaking arrangement, or if I reach out to somebody on Facebook or Instagram, is just to kind of see how they're doing. Maybe I can connect them with someone because I saw something that they post and I know someone that can maybe answer that question for them. So just kind of going to all these different events. I know there's a lot of Zoom fatigue going on, but I mean, even just kind of going up for just 15 minutes and just kind of showing your face and speaking. And I know I kind of been slacking a bit during tax season, but I'm looking forward to kind of picking that up and just kind of getting my face out there more and just kind of helping people where I can.
Yeah. Hey, I want to jump back to the return for a minute. You're talking about a 10% cash on cash return. Are you seeing deals pencil at that? Because I know that, or is that something that you're saying and you're paying a percentage current and then booking the rest till closing on the back end? How are you structuring those? Are you seeing deals pencil at a 10% cash on cash?
I am seeing some potential. The one that we did in Cummings, Georgia, that was we actually did a 10 pref on that. But that was like I say, it was a unicorn of a deal. Like it was your prototypical worst property in a great neighborhood. So there was a lot of value that can be added to it from that standpoint. There, like those come around often. Like no, and that's why we were kind of pressing hard to make those numbers work. And I mean, in a way to be beneficial to the seller as well. Where like if he wants this, I mean, we discussed seller financing. So those are the type of deals that you can get somewhat double digit returns on if you're getting more creative. Like can we get a seller credit here, and just kind of identifying what the pain points is for the owner of the property to have them walk away without trying to max out the market.
It's interesting you said that. We used to buy the Ugly Duckling. We'd go into a neighborhood and find the the worst property, the worst looking property that needed the least amount of work to bring up that curb appeal. And, and that was great because we would get the benefit of all the effort of the other landowners or the other property owners because, their properties were valued at a higher rate. So we knew that if we could do some cosmetics and some minor work, we could bring the value up. So that's interesting you say that.
Yeah. Hey, let's shift gears here a little bit. Larry, I got to tell you, I like your shirt. Abundance mindset. Love that. Hey, so talk about that a little bit. Where's that come from for you? How, where do you find, because not everybody can fall into that space, right? Or that belief, right? So where's that come from for you?
I think it's about around the people that you're surrounding yourself to, almost the whole tribe of millionaires concept where you, with the whole like you're the sum of the five people around, the average of the five people around you and whatnot. So you start to kind of network differently, kind of once again like being able to add value and someone else shows love back to you and kind of show you a different side of the world where like, okay, nothing wrong with your current friends and family, it's just they're not doing it. So you're starting to kind of see, okay, there may be opportunity here that I never thought before. And this, you kind of hear the same, you're reading books and you listen to podcasts and like everybody's kind of saying the same thing. That's kind of that positive mindset. Like basically there's no ceilings, like there's no glass, like whether like there's no box to think out of, like just kind of think of like any opportunity is there. And the same thing of how you structure deals, same thing if even for like my tax clients, it was like, okay, we're in the realm of whatever the tax code is, but you can structure your business and whatnot in whatever way you want to take advantage of certain tax deductions there. So as long as it's legal and no one's getting hurt, then there's no reason not to have that mindset in place.
Yeah, I'm a huge, Napoleon Hill talks about abundance versus poverty mindset. And it really is, it's a mindset. It's you either think the world is full of everything that's required, or you think that there's not enough. And I totally agree with you, especially when you're taking on a new venture, when you're stepping out of your comfort zone and you're moving beyond your fear. If you start to slip into a poverty mindset, you'll stop. You'll just go back to your comfort zone and you'll never stretch yourself. So that's a huge part of it.
Yeah.
I like what you said too, Larry, about the people you surround yourself with. It's kind of funny how all this circles back to relationship, right? All this circles back to your network and who you're hanging out with, who you're running with, the things that you're doing. I like, what you said about the 5 closest people to you, that's who you're going to wind up being like, right? And so, I heard it said that if you want to know where you're going to be at in 5 years from now, take a look at the 5 people you hang around with, because that's where you're going to be in 5 years. So, I read a book, and Carl, I know that you are huge on Think and Grow Rich, but another great book has been Dale Carnegie's book, How to Win Friends and Influence People. And, that is just, that's one of those books that's one of those classics, right? That you should read over and over again, because it just talks about how to build relationships with people. And I don't care what we do, we have to be building relationships, because that's just so important, because that drives you, personally as well as professionally.
And that is a classic book for sure. And my mentor Bob Proctor talks about trading up. You mentioned it, Larry. Like there's nothing we can do about our family, right? Our family is our family, and our friends. We get to choose our friends. And he said sometimes you have to trade up. It doesn't mean you don't care about these people, but if they're not running at the same pace or playing the same game you are, and we've all heard it. If you want to soar with eagles, right? Stop hanging around with the turkeys, right? And so, it's so true. Really take a look at who you're hanging around with and who you're networking with, because that makes a huge difference. And you want to be around people that are harmonious. You want to be around people that are supportive and are playing a big game, because you don't want to be the smartest guy in the room. I know I don't want to be. So do we want to talk anything about student housing? Are you in student housing at all, Larry, or does that affect your business?
I am not. We actually talked about it on some of my earlier properties because they are near some universities, but it never really worked out. So, but it was kind of interesting because it was right before COVID when we actually thought about like working with a couple of universities nearby. But we decided to kind of keep it at the market and not deal with all that red tape. So I'm not saying it's fortunate or not, but it's just kind of a unique situation that I'm just kind of observing from afar.
Yeah,
You
so
know, it's
you're more of a
interesting.
market rate guy.
I'll do market rate. I do have Section 8 rentals as well, and also short term rentals as well as um, travel nurses as well.
Student housing has always been one of those that was kind of attractive, but not really. It was attractive from the standpoint that you could take a shorter term lease, or well, you'd take a full term lease, but your tenant would only live there part time, and it would give you a lot of time to redo that unit for the next year, right? And it was always guaranteed because the parents guaranteed it. But here's the big thing these days: are kids going to go back to school? Are what's happening with attendance? I think attendance is down at colleges and universities. And if you listen to like Tony Robbins and Dean Grazioso and Gary Vee, I mean, these guys are all saying that people are looking for alternatives to education today, right? So they're not going back to the major colleges, the major universities, but what they're doing is um, they're looking at some of these, coaching and training programs. Spending a $20,000 on a coaching and training program that's going to help them accelerate their real estate investing career, or something in another alternative class, or learning how to write, or learning how to public speak, or things like that you don't need to go to college to learn. That there's plenty of other ways outside of that, either free or paid, that you can get information. And it really, so what's going to happen to that whole market, right?
Yeah, I know. Enrollment's way down because my kids are getting to the point where we're starting to look at colleges, and I mean that's good if you're a student and you want to go to college, because the colleges are now, let's face it, colleges are businesses, right? They're in the business of education, a lot of different businesses if you really look at it, and their supply and demand. Demand has dropped significantly, so that's great for the consumer. That means that they're going to have to drop their rates and make deals and everything else. But for those people that own, private investors that own multifamily in South Bend, Indiana, where Notre Dame is, or maybe like Chapel Hill, where University of North Carolina is, or somewhere. It's interesting what they're going to do, how they're going to shift and make things happen, because they counted on those higher rents from students, and they counted on those guaranteed rents from students. So it's interesting to see what's going to happen there. Maybe there's some opportunity there. I don't know.
At least from a conversion standpoint, there's opportunities there if need be. I know a lot of people are looking into buying student housing or buying hotels and motels and potentially converting them into multifamily if the job market can hold it, or there's just a limited amount of housing, rental housing from that standpoint there. So I mean, there is opportunity. It just depends on which market that you're in, which is kind of one of the other staple points of real estate.
Yeah. Hey, let me do this real quick. Let me just reset the room. Hey, if you're joining us this morning, this is Multifamily Unplugged, Saturday morning, raw, unscripted radio. If you're joining us live on Clubhouse, live on Facebook, or live on Zoom, welcome. If you have questions, would like to ask Larry anything, or Carl or myself, drop them in the chat. And if you're on Clubhouse, we're not having conversation out there this morning other than just listening and the audio. So glad you're here. Glad you're joining us this morning. A lot of people on this morning. Good to see everybody. And if we can do anything, don't hesitate to reach out. Thanks for being here. So thought we lost
By the way,
you
Larry, how do people?
Sorry, go ahead.
Larry, how do people get in touch? How do people get in touch with you if they want to reach out to you and
Oh yes, they can text me or call me at 757-535-8592. I don't mind putting my number out there. Like this thing goes off all day, every day. I
Right.
try to get back
Hey,
to people.
I'm typing it in right now. Right, 757
Yes, 535
535
8592.
8592. So 757 535 8592.
Yes, and then like I'll also drop in my link business card into the chat. I guess it's in
Yeah,
there.
if you could do that, that'd be great.
Yep.
Perfect.
So they can they can see my number up there. They can see my email. They can get a little bit to know about me and different stuff that I spoke on, as well, and there's different content that I have out there. But like I'm looking
And
forward
are
to.
you look?
I'm sorry, go
Yeah,
ahead.
what are you looking for? Are you looking for deals? Are you looking for partners? Or I mean, what is it you're currently looking for in your radar right now?
Yeah, looking for deals at the moment right now, and opportunity to partner with people. Which kind of to Mike's point, it becomes a full relationship thing because you can work with somebody, trying to find a deal, end up getting connected to more capital. But I think the main thing right now is just find a deal that makes sense, and if there's opportunity to kind of bring that person in on that, uh, with Rise group that I'm in, and like we're looking forward to connecting that way as well.
Hey, are there any recent changes in the tax laws that we need to be thinking about or looking at? Or better yet, even, do you see anything coming down the pike?
There's a lot of COVID relief for those in multifamily, and then kind of keep that in mind when it comes uh, to your tenants. If they're going to get, like, if they were affected by COVID and couldn't work, okay, could they file their taxes and potentially receive these there's almost like $17,000 of credit someone can receive. So they could be getting additional refunds that could help them along the way there. I know the whole one of Biden's political pushes was trying to get rid of the 1031 exchange, which is interesting, kind of considering like how much, and people know that a lot of political figures. It's not just private investors. There's a lot of public figures and political figures that take advantage of that as well. So it's like, could that potentially happen? Um, I mean, yeah, I guess anything can, but you're still looking at roughly a year, 2 years down the road before something ever gets passed. Even with the Tax Cuts and Jobs Act with former President Trump, that took a year and some change to actually like go into place there. But there's always different strategies to kind of, I won't say counteract, but it's like typically there's a give and take when it comes to the government. But those are kind of like the main things that potentially are down the road right now. And I know everyone's kind of fully aware that they extended the due date to May 17th. But if you still need more time, you can still file an extension and have until October 15th to get all your information together and file and pay on time.
Mike, did you have a follow-up question? Because if not, just real quickly, Larry, tell our listeners what Mike and I obviously know what a 1031 is, but just real quickly, tell them what a 1031 is.
Yeah, so basically, 1031 is a government tax code that allows you to take the gains from the sale of your investment, and then basically do a like kind exchange. So basically, real estate for real estate. From that, you just can't take the gains of it and then buy stocks. So it typically is a like kind exchange, and you can roll your gains into your next property. So it's almost like playing Monopoly when you finally get the four greenhouses and then the red the red hotel. It's basically a wealth strategy opportunity, but then the tax code to kind of help um, uh, basically level up from that standpoint there, and you basically
Yeah.
defer those gains down the road, and then apply different strategies of whether you want to pass that down to your kids when you pass or whatnot. But that's the premise of it. There is basically deferring the gains into another real estate property or an asset of like kind.
So if I buy a property for $250,000 and make 50,000 on it, my capital gains, I can take that 300,000 and roll it into another like type property within a certain period of time and defer the taxes on the 50, right?
Yes.
Yeah. So that's a strategy for real estate investors that anybody that's bought and sold more than a couple properties, understands. So for the new people out there, it's a really simple strategy that's completely and totally available to any property owner, to defer taxes on capital gains, which is always a good thing. So thank you, Larry, for that.
Thank you.
Yep. Hey, we're getting winding down to about the end here. So any last thoughts or comments?
No, I'm sorry, Moose, go ahead.
No, go ahead, Larry.
No, I just want to say just thank you for the opportunity to come on and add value. Like, this is pretty cool that you all do this every Saturday just to shoot the breeze, and hopefully I was able to add some value.
Yeah, appreciate you being here. And I know we've been waiting for this for a couple of weeks. So yeah, you always add value. And I think that's just the thing in nature today, right? Is go somewhere and add value. Do something for somebody else. Give it back to somebody else, because we got it from somebody, so we might as well give it back to somebody, right? And I think that's part of that abundance mindset.
Yeah, it was John Maxwell. I forgot which one of his books where he said to be a river, not a reservoir. And basically, like, all the information that I have with the tax code and real estate, like, hey, what's the purpose of me just kind of holding it into myself? Like, being able to pass that through allows me to receive more from that standpoint there, and continually, because at the end of the day, when I'm gone, I'm gone. But I do want to at least say that I've given as much as I can, whether information wise, financially, whatever. Is like, if it makes sense to just go ahead and give it out, okay, why keep all that in? Because it's useless if I just it gets stale and it doesn't grow me if it just stays in one place.
That's great. Yeah, Bob. I quote Bob Proctor a lot because, like, he says, "Let it flow to and through you," right? Like a conduit. So, great philosophy, Larry. Really great to meet you, and thanks for taking some time away from your busy day and spending some time with us. Really appreciate it.
Well, thank you too. Thank you too. Looking forward to further discussions. And if anybody want to reach out, my information is in the chat. Please don't hesitate to reach out. And looking forward to meeting everybody, whoever reaches out.
Hey, Larry, you're on Clubhouse, right?
I'm not. I do not have an iPhone.
Oh, okay. I thought you were. I don't know why. I thought I've seen you in a couple of those rooms. But anyhow, make sure you're following me on social media. On Facebook here, I'll tag you on this one. It's done later today. And Carl, as usual, good to see you on Saturday morning, my friend. Especially after a nice cigar and a little bit of fellowship last night, huh? So
yeah, hey, Larry, if you ever make it up to Chicago, you gotta look Mike and I up. We usually get together every now and then.
Well, it's going down. It's going down.
Looking forward to that. That's for sure. Hey, everybody, thanks for being here today. Whether you were on Clubhouse, Facebook, or Zoom, we are here every Saturday morning, 10 o'clock. Hopefully you got a wealth full of knowledge today. I know that we talked about a lot of things that we just generally don't talk about. We really kind of ground into some multifamily stuff here. So if you didn't listen to the whole thing, go back and tune into the recording later today, because there's some great nuggets and I think a lot of good information that you can pick up. Again, Larry, thanks for being here today. Larry's information's in the chat. If anybody needs it, you can DM me or Moose, and we'll get that to you. Moose, great to see you as usual. Look forward, guys. Have a wonderful day. Great weekend. Enjoy the family.